Welcome to the continuation of the current federal tax developments dealing with the Tax Cuts and Jobs Act, this time looking at business changes in the Tax Cuts and Jobs Act for the week of December the 18th, 2017. As before, current federal tax developments are brought to you by your state society of CPAs and by the Lascalzo Institute, a Kaplan company. Well, hopefully you took a bit of a break if you've actually watched the first one. And if you just stumbled into this one first, remember there is a second one that deals with the individual provisions. We're not going to deal with all the provisions in the Act. I'm really not going to talk about the international provisions. That mainly affects large multinationals and to a large, well, it affects there actually affects more. But the major effects are going to be large multinationals for the onshoring part of that deal. And my guess is, first thing is that's a very complex area. Secondly, almost everybody looking at it right now is still trying to figure out how that new part's going to work anyway. So we're going to have a lot of fun with that. Let's try to get to stuff, though, that the vast majority of you have to work with, which is going to be the stuff here like these business changes and the individual changes. So we're looking here at the business changes. And again, as I warned you before, we're not looking at all of them. So there are parts here that, aren't going to be, we're not going to talk about here. So don't assume much from what's here. Now, this is the Tax Cuts and Jobs Act, again, conference report, as we mentioned last time, issued on December the 15th. Final version posted 5:30 that day. It is, in the business provisions, just like the individuals, primarily taken from the Senate version of the bill. There are some items coming from the House, but most are the Senate. And again, looks like we have the votes to pass it next week. So if all goes as scheduled, and if you're listening to this later on in the week, you'll know if it went as scheduled. If it goes as scheduled, they are planning as of the moment to have the vote on Tuesday in the House, the last I heard, and they're hoping to have a vote on Wednesday in the Senate, and that would allow them to sign the bill by the end of the week, certainly before Christmas. Again, like I told you on the individual one, I know we've been talking about this bill for a few weeks, and we've talked about things that are in the different bills and amendments and all those issues. With a conference bill, you start from scratch. Don't assume I'm not going to talk about things, I'm going to talk about things that are from this bill. Don't just assume that something that was mentioned 3 weeks ago that was in the House bill, especially things that were in the House bill, have made it into the final bill. A lot of House bill provisions did not make it into the final bill. And some Senate provisions did. And in fact, even some provisions in both bills. We got to the conference, they just got rid of them both. So we're just done. So in any event, take care. Don't go overboard on this, but, kind of work with it. And if you have not gotten the conference report yet, get a hold of it. That's going to be our best document to look at this with for quite a while. Obviously, I expect it to be the first things that CCH and RIA get published. And yeah, you might as well go grab it off the website. You don't really need to wait for your service to get it going, okay? Again, we will not cover everything by a long shot. Specifically, I'm not going to talk about the changes to restricted stock units. That's kind of an interesting area, but it's a bit messy. And yeah, we're just not going to do it. And non-public companies I work with haven't really issued them that often. Now, individuals run into them in public companies, but I think you're going to find the changes are going to kind of stop those from the public companies, right? And like I said, specifically, I'm not looking at the international corporate tax regime changes. Those could cover a whole nother program besides what we have here today. Well, as I said, remind you about the corporate alternative minimum tax, no corporate AMT. So the corporate AMT had a short resurrection and died quickly thereafter, after they finally realized that having a corporate AMT running at 20% with a corporate tax running at 20%, yeah, it just didn't work. And even though they're going to move the corporate tax above 20%, a 20% AMT would still have basically meant the vast majority of what they did otherwise. Anything that wasn't allowed for AMT would be, for all practical purposes, not allowed for regular tax. That does leave us with an issue. What if your C Corp has a minimum tax credit carryover? Well, the bill makes clear you can offset that against your regular liability for any year. And if you can't offset it entirely, we're going to make it refundable. If you have unused after you offset all your taxes for 18, you get a refund of 50% of the amount you could use. And we're going to do the same test in 19. Again, a refund of 50% of the amount you couldn't use. And we'll do that as well in 20. In 2021, if you still got some you never could use, we're just giving it back to you. Okay. So all minimum tax credit will be back to you by 2021. Okay. That'll be the impact on the corporations. Corporate tax rates, a flat 21% rate beginning in 2018. The Senate bill would have begun it in 2019. They did find the money here to move it up, so it is going to start January 1st, 2018. The corporate rates for tax years beginning in 18 will go to 21%. And interestingly, there is no special tax rates any longer for personal service corporations. The PSC rules are gone. And there are those of us like myself who are in practice long enough to remember when professional corporations tended to be set up as C Corps. Now, whether that still makes sense, it'd be a whole nother question. But given the difference between 21% and 37%, you're going to have to start asking yourself, are there cases where a closely held C corporation may make sense, even with that risk of double taxation on the back end? And I would say it makes a huge difference if the taxpayer in question is one that could qualify for 1202 treatment. Because if you have an entity forming that qualifies for 1202, then it seems like it's really difficult to figure out why they shouldn't be a C Corp under this structure. But even some that don't, again, with that rate differential, 21 versus 37, so we're looking here at a 16% rate. 16% of the earnings I can keep in my pocket. If I'm a C Corp that I would have to pay out if I floated out to the shareholder, then maybe I want to hold on to them. It's an open question, but again, C Corps may not be as easy to quickly dismiss as you did before because of this rate differential, because they are way lower than the individual rates, not just slightly as they were before. A big change in the law is the new bonus depreciation rules. First thing is we extend bonus depreciation through 2022 at 100% rate. So we're back to, remember, we've had that once before, very short-lived 100% bonus depreciation. Now it's going to be a much longer-lived 100% bonus. Unlike 179, bonus depreciation does not phase out. Unlike 179, bonus depreciation can create a loss. So 179 is, there, but bonus is kind of nice if you can use it. And it's effective for assets placed in service after September 27th, 2017. So we're already have in service assets that are going to get or eligible for 100% bonus depreciation. So that's something when you're preparing the 17 returns, you're going to have to remember this year, is that we have a bonus of 100%. They will allow you an option if you have a fiscal year that cuts over. So you have part of it in part of it in 16 year, part in 17. You started this year, you believed it was going to be a 50% bonus, and for whatever reason, you desperately want 50%, not 100. You will be able to make a 50% election on that 1 year if you have a fiscal year that has that problem. Okay. It'll phase out after 2022. We have this is here from the actual committee report. That's why you see the footnotes there. Didn't reproduce the footnotes. So the rates would go in 2023, it'll go to 80%. It drops by 20% a year. So in 2027, it's gone unless you have long-lived property. Then you have that final year of 20. That phases out a year behind. So again, it's scheduled to go away beginning in 23 and would be totally gone by 27. Now, the big thing is no longer must the property be new. It just cannot have been used before by the taxpayer. Okay. But it does exclude any property used in a business that have floor plan indebtedness unless it's not a tax shelter and it's exempt from interest limitations due to being a small business. If both of those are true, then you're fine. Now, that presages a thing you're going to see come up in the next few, you're going to see a few times here. Certain industries will have the right to opt out of using this bonus, or they'll have to, if they don't want to get hit with what was the trade-off for this, which is a substantial reduction in interest expense deductions, they can't use the bonus. So this is just the first part of that, okay? Those other industries are going to have to choose bonus depreciation or a full interest deduction. They'll have their choice. So that gets an interesting call coming down the line. Luxury auto listed property, if bonus depreciation is not claimed, then the maximum for those will be $10,000 for the first year, $16,000 for the second, $9,600 for the third year, $5,760 for each year thereafter. And one really nice change, computers will no longer be listed property beginning next year. That's been a problem all along. We're waiting for the service to exam. As you and I both know, it has to be a computer. It's a listed property unless a computer used exclusively in a business location owned by the business. All of us know that the vast majority of computers sold today are laptops. And we have them as laptops because you need to take the computing on the road with us and outside the office. The problem is, if that computer leaves the office, it's listed property. And, who in the world can keep records on the actual use of the computer outside the office? But you have to. Otherwise, you face a disallowance of the deduction because it's like a car. And unfortunately, Congress doesn't react quickly. They've now finally figured that computers are not that expensive. They're used by everybody, not just, quote, high executives. This is not being given to the execs getting some perk. It's really average persons end up with these. This should not be treated differently than any other business asset. So good news, it's off the listed property list. Farming equipment gets special rules. We're going to shorten the recovery period from 7 to 5 years. For most machinery and equipment used in a farming business, there are some exceptions. But you have to use 150% declining balance for any farming equipment. That's a caveat and a problem that you might want to take a look at. We have to be using that for it. And then the other catch is, I should say that's it for there. We get there. Now, this rule also creates a new category of improvement property. It combines qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property into a single category. That property gets a 10-year recovery period. And it's all eligible for Section 179 expensing. Now, restaurant building property won't qualify for this. That's a little different structure, so it has to be set up separately. A real property trade or business that does not want to be nailed by the interest limitation we're going to talk about here later has to agree to use ADS, the alternative depreciation system, to depreciate all real and improvement property. They're going to give up the accelerated depreciation systems, or they've got to face these rather strict limits on deducting interest. My take is most real property businesses are going to end up saying, look, we got to use ADS. We have to use it because, losing all the interest deduction for us would be a killer. So we're just going to take slower depreciation rather than lose all that interest deduction. Now, this is what I thought was coming up a little second ago, which is why I started going with farms, because we have that detour under the law before we get the second farm issue. A farming business can elect out of the limitation on interest deductions. And if it does so, it must use ADS to depreciate any property that has a recovery period of 10 years or more, like special purpose agricultural facilities, otherwise known as greenhouses. You have to do those over 10 years, but you can take all of your interest then. Okay, that'll be part of it. 179 gets expanded. Now, maximum amount is going to be $1 million, and the phase out begins at 2.5. The only problem is, and there are some reasons, but generally, if you think about it, most of what we're currently taking 179 on would qualify for bonus, except maybe it was used. Well, now, if it's used, it can still get bonus. So I'm not sure 179 will be used nearly as much as it used to, but there are still a few things they're going to add that are here. They're going to expand the definition to include depreciable, tangible personal property used to furnish lodging or in connection with lodging. So that's helpful, right? We're also going to add the following improvements if they're done to property after it's first placed in service: roofs, heating, ventilation, and air conditioning. All of those which currently cannot take 179 against, you'll now be able to take 179 against. So those will be useful. So again, you'll be using 179, but probably for stuff that you weren't used to using it for, and not for the stuff you were. Also in the list, fire protection alarm systems, they can be 179. Also, security systems can be 179. This next one is, I think, really important for a lot of you who are following along on this program, because I think most of the people following along this program are working with small businesses. And if you are, this is a huge advantage. Any business that has an average gross receipts for the past 3 years of less than 25 million. Now, this is running, you get too big, you'll pop out of this, but you're automatically allowed to use the cash basis of accounting regardless of what type of inventory you have, what type of business you are. Unless you're a tax shelter, you're going to be able to use cash basis. That includes C Corps, right? We're changing the rules. 25 million will be the kick. If you're below 25 million, you will not be required to track inventory. You will be required to track it as supplies, so it's in one sense not a difference, but it means you can be cash basis. So inventory is not there. What's really nice, though, is those same businesses, even if they do stay accrual and do have inventories, they're exempt from the 263 Cap A unicap requirements. Remember, in the past, only resellers with under 10 million could qualify for exemption from unicap. Now, resellers and producers up to 25 million are exempt from unicap. So that's nice. And the small contractor test that previously was at 10 million, you had to have $10 million per year to be a small contractor. That's now going to $25 million a year. So 25 million will be the new limitation for a contractor. So small contractor, if they have total sales below 25 million, that means that some contractors will now be able to come back, off percentage of completion if they want to use completed contract, or they want to even go back to the cash basis or pure accrual basis and use the retentions option. Those will all be possible because, it might have been difficult to keep your contractor from going above 10 million, but a lot of contractors can run very profitably and comfortably around 10 to 15 million of revenue. And in fact, they usually go down in profitability if we start getting them up much above that. So you might find somebody who previously, had to say, no, I can't be a small contractor, but they may be somebody who's going to stay perfectly at 15 million. This could open up some real opportunities for them. So, keep track of this new small business accounting method simplification rule. Congress believes that some S corporations are going to look at the C and decide that's a better deal. If you have an eligible S corporation converted to a C corporation, Congress is going to help you some. If you have to change your accounting method. Now, this was mainly aimed at having to go from cash to accrual. Because you were an S corporation, you're on the cash basis of accounting, but you're over 5 million in revenue, right? So you'd have to be accrual if you were C Corp. Well, now that's not going to be true. Now it's 25 million. But let's say you are a $30 million a year S Corp that's cash basis. Well, if you go to C, you're still going to have to change to accrual basis. We're going to give you 6 years, not 4, to have the spread for that 41A adjustment, right? The difference to get you back from cash to accrual on a tax basis. You're going to get to spread that over 6 years, which will help. It's going to reduce it significantly each year's addition. It'll go on longer, but it'll still be reduced each year. Now this part's not totally clear, and I'm hoping I'll deep reading the bill, I'll get this straightened out in my mind better. It says literally, though, if you read the description, the conference committee report, that any distributions made by this corp will be split pro rata between earnings and profits and AAA if it still has AAA. Now, I'm assuming that means after we have the 1-year period, the post-termination transition period, where we can distribute out AAA tax-free. I'm hoping that this doesn't get rid of that period in this case, and hopefully it doesn't. But then it means if you can't get it all out, then we still have, a way to get back into AAA. The AAA doesn't die after the year. And by the way, who's eligible? You have to have been an S corporation on the day before enactment of the bill. Now, the bill's enacted on the day the president, or he lets it go into law without his signature. I kind of doubt he's going to let it go into law without his signature. He's going to want to have that Rose Garden ceremony, okay? So let's go 99% chance, as long as it passes, that Donald J. Trump will sign it. The day before Donald J. Trump signs the document, you have to have been an S corp. Okay, that's date of enactment. We do not know what that date is yet because we haven't been told, right? They haven't passed the bill, so we really can't be told yet. Once it's passed, the signature date, that becomes date of enactment, and that's the date you need to have been an S corp. So whatever you do, don't go terminate your status right now if you want this benefit. You have to elect to terminate within 2 years of the date of enactment. So you were an S corp on the date. You make your termination within 2 years of that date. Now, that's going to mean you could terminate in 18 and most of 19, but probably not after Christmas in 19. That's going to be my bet. It needs to be before Christmas and probably before the 22nd to get it done, right? And the owners are the same on the date of termination as they were on the date the bill was enacted. So, the owners are the same date of termination as date the bill was enacted. If all those are true, you qualify for this SCorp relief. If you need this relief because you need that 6-year spread, it's either cash basis or some other thing, a method you can't have once you become a C Corp, then, take a look at this special rule. And again, it's only for 2 years, but it allows you to get some relief when converting to a C Corp. Now for the mess. What Congress wanted to give us expensing of equipment immediately. But the theory was they were going to do that, but they were going to say, but you can't finance this. So originally a proposal was give 100% expensing for equipment, but not allow any deduction for interest related to that equipment. Okay, that didn't really go anywhere totally, but they did decide to do a rather strict reduction. Your business interest deduction is limited to the total of what's called business interest income. Be careful, that's not as broad as you think it is. 30% of the adjusted taxable income of the taxpayer and floor plan financing interest for the year. And by the way, the floor plan bit got added because obviously the car and boat dealers were freaking out when they were going to lose the interest. So that interest is automatically allowed as well. Any disallowed amount is carried forward indefinitely. Now, don't forget, if your business is under 25 million, this is not going to apply to you, right? You can just skip the whole thing. But if you're above 25 million, you're in this thing. Business interest income does not include investment interest income. So that means if you have, money sitting in a money market account and you're earning interest on that, that's not going to increase the amount of interest expense you can pay, you can deduct. So in that case, you probably need to get rid of the money market account. Pay down the debt if you're not being able to deduct it. That'd be the key there. It does not include that income. It includes business interest income that is directly tied to the business. So for instance, like a bank would have interest income directly tied to the income, to the business. And it would appear probably that like interest income you're receiving where somebody's late paying on accounts receivable. purposes, ties to the business. Now, the adjusted taxable income, the House was going to have it be effectively EBITDA. The Senate was going to have it be taxable income. And yeah, we kind of split the middle. We kind of came in here a little different. So it's going to be the taxable income of the taxpayer without any item not properly allocable to a trade or business. And business interest expense cannot include business interest expense or business income. Will not include a net operating loss deduction. But only beginning in 2022, you'll add back depreciation, amortization, and depletion. It turns out, right, the Senate didn't want those last three in there at all. The House wanted those added back. So they kind of said, well, what we'll do for 18, 19, 20, and 21, the first 4 years, we won't add them back. And the theory is that that'll let companies adjust and get their interest down. And then we'll start adding them back in 2022. Or I should say, no, we'll let them get down. It's kind of, in any event, we can't add it back. So, yeah, for 4 years, we've got that. Weird rule. Floor plan financing indebtedness, what is that? It is any amount paid to finance the acquisition of motor vehicles held for sales or lease and which is secured by that inventory. Motor vehicles are any self-propelled vehicles designed for transporting persons or property on a public street, highway, or road, a boat, or farm machinery or equipment. So those are all the categories that come in. So cars, trucks, tractors. We're talking about tractors, tractor-trailer tractors, right? Those sorts of things. As I said, boats, farm machinery or equipment. Construction machinery or equipment was on this list, but struck. The Senate took it off, and it was not put back on in conference. So if you're selling or leasing construction equipment, no, you're not going to qualify if you're paying for flooring on that. Special rules are used to make this work for holders of pass-through interest. So they've got to make sure things aren't double, triple counted. You've got the problem there. Well, I've got these three pass-throughs, and maybe this one has too much interest, so really it wouldn't be allowed to take it against that. But I've got unused 30% over here. So, how do I make all that work? So they've got special rules to prevent people from gaming, but to prevent, it's kind of messy. Just going to tell you it's messy. So this is why one goes to a course that will go all through this whole mess in detail, walk you through this. But it's messy, it's there, but there is a mechanism for doing it. And in that case, there's going to be a special carryover required if you do have excess interest from a pass-through. Okay. Now, it does not apply to certain regulated public utilities. Does not apply to small businesses, the $25 million limitation we talked about earlier. If they elect, it does not apply to a real estate business that's defined by the way, a real estate business was defined by reference to the real estate professional rules. So it's all those things that qualify somebody who's a real estate professional. That's a real estate business. Okay. And also farming businesses and those engaged in the business of an agricultural or horticultural cooperative are also allowed to opt out. I wouldn't be surprised over time if other businesses start lobbying to get the choice to be able to come here and deduct their interest or to get their rapid depreciation. But yeah, it's going to complicate rules for those. Big change in NOLs. Net operating loss carrybacks are allowed in only very limited circumstances. Only in the case of natural disasters for small businesses and farms, they can go back 2 years. And property and casualty insurance companies are allowed to go back 2 years. But that's it. And net operating losses can only offset 80% of taxable income in any year. It's like, wait, isn't that like the old AMT? Yeah. Well, we got rid of the corporate AMT and we just moved this over here. By the way, even though we're talking about this in corporate, it's kind of, Congress looks at this as business. Realize this applies to individual NOLs too. They have the same problem with the 80% offset, okay? Like-kind exchanges are now limited to real property only. So you can no longer do the like-kind exchange rules apply if you trade in a piece of equipment. And what you're going to have to do in that case is recognize the gain on the trade in the piece of equipment. Congress says, well, that's okay because you're going to be able to offset that by the 100% write-off, which I say, well, that's great, except the 100% write-off goes away in a few years, and this rule doesn't. But that doesn't bother them. So understand that. If you do have an exchange basically in play right now, where you've already disposed of the property or you dispose of the property before December 31st, 2017, there are rules that will let you complete that exchange without a problem. Okay, but you do have to have disposed of the property to be let go of by December 31st in order for you to get the carryover rule. This one was changed pretty dramatically in the conference bill because a lot of people expressed concern about the way it was worded, that it could have caused a lot of other problems they weren't thinking of. So we're still going to have Internal Revenue Code Section 118 that allows for tax-free contributions to capital for a corporation. But they're going to specifically say what doesn't count is any contribution in aid of construction or any other contribution as a customer or potential customer. Okay, those will be taxable, as will any contribution by any government entity or civic group. Now, if either one of those are also shareholders, then you don't have a problem. But if they're not a shareholder and you get a contribution from either of those under these circumstances, then you got to record that as income. You can no longer use 118. Now, 118 only affected corporations anyway, even though people tried to apply it to partnerships and individuals, and it doesn't work there. But, Congress felt that basically local governments were sort of buying off companies. And who knows, maybe this was finally influenced by, there's been a lot of fighting over the Foxconn deal in Wisconsin. And, some of those issues, things like that. There's a belief that the states were bidding with each other, and the Amazon headquarters issue, and saying, nope, we're not going to allow these contributions to capital by the state and local government. And the state and local governments who they really were upset with. So that's what they were aiming for. Commentators said, then why not write it to just address those? They finally did write it just to address those. Section 199, we hardly knew ye. There will no longer be a subtraction for domestic production, that wonderful form that we've been doing for a few years. And if you remember, which the Commissioner of Internal Revenue at the time begged Congress not to pass because it would be wildly complicated for very little benefit. Well, it's gone now, right? Congress believes lower rates and the equipment expensing make up for the lack of 199. So 199, this is your final year for 199 in the domestic production activities deduction. This one will surprise a few people. We're getting rid of technical terminations for partnerships. Section 708's provision that says if you have a sale or exchange of 50% or more of both the profits and capital interest of a partnership within a 12-month period, you have a termination of the partnership is gone. Why is it gone? Because they score this to raise money. Because it turns out that if that happens to you, you're allowed to reset all of your elections, including ones that you could only get out of with IRS permission. You now no longer need the permission. It may not surprise you that some people would try to manipulate things to get a tech term, to get out of an election that turned out to be not so wonderful. So tech terms will be gone next year. So that's probably good news for most of you, simply because they more often tripped us up. If you were using them for planning purposes, it's not a good thing. But if you weren't using them for planning purposes, they were an easy way to get tripped up. It did not remove the standard termination. So, if we basically cease to operate the entity or we end up with only one owner in a partnership. But that's a pure termination. There's no successor partnership behind it. Denial of deductions for entertainment. Congress has decided to go after certain deductions. No deduction will be allowed with respect to any amounts of qualified transportation fringe benefits paid to an employee, or unless it's necessary for the safety of the employee, any cost of providing commuting transportation to the employee. Okay. Basically, we're getting rid of that. We also get rid of, don't mention it here, it's in a separate section, but we also get rid of that whole bicycle commuting special break. We also are going to start a phase down and then out of the deduction for meals provided to employees through an employer eating facility, for the convenience of the employer. Beginning next year, previously that didn't get the 50% haircut. Beginning next year, it'll get the 50% haircut through 2025. But here's what's more interesting. Unlike other things in the Senate bill that in 2025, this one simply becomes then fully disallowed. After that date, all of those payments for those meals, right, for the employees that previously were fully deductible will become totally non-deductible. And so if you remember the Jacobs case from last year, we talked about the Boston Bruins and the hockey team getting full deduction for meals. Short-lived victory. It's going to go down to 50% like the IRS argued next year regardless for the Bruins. And 2026, the Bruins are not going to deduct any of that food they're feeding the players. We'll have to see if they can go, if they can find somebody to get the law changed for them in the interim. But as it stands right now, the Bruins are going to lose the entire deduction. Well, Jacobs was a great case. It just turns out that it's not going to matter. Now, if you're a not-for-profit organization, you're tax exempt. If you pay non-deductible fringes like that to your employees, certain ones of them, you have to add that to unrelated business taxable income. That includes a qualified transportation fringe benefit, a qualified parking fringe benefit, or an on-premises athletic facility. The idea there is to force you, in essence, here's the catch. You say, for the for-profits, we said you can't get a deduction. Well, that's not going to matter for a not-for-profit, for a tax exempt. So for tax exempt, we're going to say, well, we're just going to impose a corporate tax on you on that income. So obviously, that's meant to discourage them from doing it. We have some special rules for self-created property. Self-created assets that are not treated as a capital asset anymore. Invention, model, or design, whether or not patented, or a secret formula or process. This will be true. You will not get, it can never be a capital asset if it is either held by the creator or it's held by somebody, but their basis is still being determined wholly or in part by reference to the basis of the creator in the asset. The idea here is they want this taxed, fully taxed as ordinary income at least once, 100%. And only then will they call it an asset that could be capital. But the creator will never be able to treat this as a capital asset. This could complicate sales of some businesses, though, because, you sometimes have that questionable, whatever that intangible property is. Well, if they're buying the corporation, if they're buying all assets, including all intellectual property, might be owned by the corporation. Are they buying any of this stuff? Because if they are, that'd be ordinary income. And if it's like a sale of an S corporation, then that could be significant. As ordinary income is a capital gain. Maybe ordinary income. Okay. We have these issues. Well, I repeated myself. Not good. On the slides. Those of you not seeing the slides, don't worry. You don't see the repeat. We do now have a 3-year holding period for carried interest. This is mainly those investments and hedge fund partnerships where the people running them were given an interest. They didn't necessarily put the money in, and they were not paid for services, right? In essence, instead they just get like a 1% of the return, which is mainly dividends, interest, and the like. Well, Congress did not go fully after this. In fact, we might say they did as little as they could, but that's okay. you have to hold it for 3 years before selling it, your interest, before it's a capital gain. And these were sold, so there is some value there, and they have to hold it for 3 years. It looks at whether investment activities conducted by the partner, where the income would come out most often as ordinary income. Those type of partnerships get tripped by this, okay? But again, any partnership that is giving a services interest to a partner, you should at least make sure you're not accidentally going to come under this rule. Probably they're not going to sell in 3 years anyway, so probably it's not an issue. But there is this special 3-year holding period for a carried interest for an investment style partnership. The next one caused some angst among some people. You're going to have to capitalize research and development expenses and then amortize them over 5 years if the R&D is conducted in the U.S., or 15 years if conducted outside the U.S. And you will no longer be able to elect to amortize R&D over 10 years. Remember, we got rid of the corporate AMT. We can get rid of the individual AMT, but why? But we're not going to let you go 10 years there, when it would be, 5 or 15 years here. So we're not going to let you get away from it that way, okay? It is a change of accounting method. You have to report it that way, and it is going to be accounted for on a cutoff basis. This next one well, I've mentioned before, I didn't understand how it was going to work. I was hoping it wouldn't show up in the final bill, but it did. The revenue recognition timing conformity provision lives. You must recognize income for tax purposes no later than the year you recognize it in your applicable financial statement or other financial statement identified by the IRS. It applies to accrual basis taxpayers who are subject to the all events test, which basically is pretty much all of them. So if you're on the accrual basis of accounting and you have either an AFS or you have some other financial the IRS will identify as filling in for the AFS, then you've got to report your revenue at least as quickly for for tax purposes as you do for your financial statement purposes, whatever that applicable statement is or whatever other statement the IRS has identified. Notice this does not mean you get to defer. If the tax law says you recognize the income today and GAAP says, oh, no, you don't get to recognize that for 5 years, you recognize it today for tax purposes. It says at least as quickly. It doesn't say at the same time. Now, this will be interesting because we're trying to apply broadly. I mean, I understand why, because Congress gets concerned. There's going to be these articles in the paper about, this corporation that showed no income, but has this financial statement showing, all this revenue and all this income, yet the revenue is not on the tax return. And yeah, they're trying to solve that problem. But GAAP and tax just really don't combine well. We'll see how this works. They did codify Reg Proc 2004-34 on advance payments, which I think is where they got this idea. Because that was the one where if you got an advance payment, you could delay reporting it so long as you reported it at least as quickly as you did for financial statement purposes. There, that makes sense. I'm not sure it makes sense broadening it all the way out, but that's what they did. Apple financial statement has exactly the same meaning that it did for the capitalization regulations where you make the de minimis election. Remember, we have to worry about do we or don't we have an Apple financial statement, an AFS? It's the same test. First test is, do you have a statement that goes to the SEC? If not, do you have a statement that's audited by an outside CPA that's used for a substantial non-tax purpose? If not, do you have a statement that goes to a governmental agency other than a taxing agency? The first one of those you have is your AFS. And that's what you're going to have to report at least as quickly as, if you have one. And that'll be effective next year. So I don't have a whole lot of time to figure out how to make that one work. Well, Congress reads the newspapers, and so they've decided that we're going to bar a deduction for sexual harassment complaint settlements. That is any amount paid to settle a complaint with regard to sexual harassment or sexual abuse if the settlement is subject to a non-disclosure agreement. This is the Harvey Weinstein provision added to the bill. Well, actually, when we first started this bill, it was a Harvey Weinstein provision. Now, well, turns out another number of congressmen may have had this provision, but that wouldn't have been deductible, so we don't worry about this. So this is the Harvey provision. And Harvey, maybe now plus a whole bunch of others. We've had a whole series of Hollywood people and a whole series of politicians. We're just getting all kinds of people into this mess now. So in any event, but if there's non-disclosure agreement, it won't be deductible. And by the way, it's effective for any amount paid after the date of enactment. So I guess what they're saying is if somebody wants to cover up if somebody wants one of those cover-up settlements, apparently you need to get it all paid out here in the next few days, because you have until until the day after it's signed by the president in order to be able to claim your deduction, right? The day after it's signed, you won't be able to. So you've got to do it at least by the day he signs it. There's a weird provision, and it was added to attract the vote of Susan Collins, and it's still in the final bill. That's Senator Collins. There's a credit equal to 12.5% of wages paid if you pay an employee on FMLA leave that you didn't otherwise have to pay, and you're giving them at least 50% of their normal wages for your program. You must have a written policy that's qualifying. So there's certain standards that are in the rules that you have to meet to do this, but you'll get this 12.5% credit. Now, it's only in effect for 2018 and 2019. Then they're supposed to study continuing it. But it appears it's one of those things Senator Collins has wanted for a while. So they added this to the bill to sweeten it for Senator Collins, because remember, Senator Collins is having to swallow the fact that they're taking away the Affordable Care Shared Responsibility payment. She's taking some heat for that back home in Maine. So they gave her this as kind of the trade-off for her accepting the other. Foreign partner gain from the sale of partnership interests. That's also weird in here. Sale of, it won't be stock, but it'll be partnership interest by a foreign partner will be effectively connected to income if the sale of assets of the partnership would have led to effectively connected income for the partner. But here's where it gets quirky. If you buy that guy's interest, you're a U.S. shareholder, or actually even if you're not, according to this, but they got to get it enforced. So if I were to buy the interest from that foreign partner, I have to hold back 10% of the purchase price and send it to the IRS. If I don't do that, the partnership has to withhold an amount equal to that from their distributions to me as the new partner and send that on to the IRS. Because I owed it, I didn't pay it, so they take it from me. The idea here is we're going to force them to report this. The catch was, obviously, if we sold the assets, we owed tax on effectively connected income. But if we could sell our partnership interests, that was a security sale. Now, it was changed so that the IRS is allowed to set up systems to allow brokers to do this, because especially large publicly traded partnerships probably do have partners who are foreign. So there'll be some interest holders that are foreign, and you're a random buyer. You have no idea who you're getting your interest from. So the idea is to allow the broker, while executing the trade, when it comes in as the interest is sold, as they acquire the interest, they take the 10% out and send it on to the IRS. We also have the modifications of substantial built-in partnership loss rules. This is an anti-abuse provision. They add a brand new type of substantial built-in loss that must be recognized on transfer, even if no 74 election is in effect. Here's the catch. Remember the rule, if the total basis of our assets were more than $250,000 less than more than $250,000 more than the fair value of all of our assets, net of liabilities, right? Then we had to report a 743 adjustment, right? That is, report the write-down of the interest to the partner who bought an interest in there. Well, what some people apparently had done, this got the IRS upset, was, okay, we'll just put a bunch of assets in there, right, that have gained, but we will specifically allocate to the new guy coming in this loss on this piece of property, and this loss is going to be like $300,000. But because overall the partnership had like 140,000 worth of other gains, it didn't trigger the substantial built-in loss rules. Now, if you're going to allocate more than 250 to a partner in losses, that's a substantial built-in loss that will trigger having to do the Section 743 adjustment and basically reduce that person's loss when it goes out, right? By giving that adjustment on the K1. So, that's not one they're going to like. We also have a clarification dealing with basis of our partnership interest. The basis loss limitation rules apply to charitable contributions and foreign taxes. They both reduce basis. Now, presumably we thought they did, the IRS did, but the code wasn't totally clear. So they said, okay, the contributions reduce your basis. Taxes, here was your problem there. $1 million of foreign taxes, the partnership does. Well, the partnership could elect to take that as a deduction, right? You elect to take that as a deduction, or it could take it as a credit. If it's a credit, there was no deduction. Well, what the law now says is if a credit is claimed on foreign taxes paid by a partnership, the partner still reduces the basis in their partnership interest by the amount of taxes taken. And the amount of that taxes could be considered for the credit or the amount of charitable contribution is also limited to your basis in the partnership. So it clarified that those aren't somehow outside the basis rules. We also added a few special provisions for electing small business trusts, ESB Teas. So if you have those, there's a couple of changes that are, well, they're for all they're worth. It probably, they may not apply to you, but if they do, they're fine. First, an ESBT can now have a non-resident alien potential current beneficiary. Previously, since that was not eligible as corporation shareholder, we couldn't have that type of potential current beneficiary. Even if we avoided sending things to him, we needed to figure out some way to get him out of there. Now that's not a problem. And they clarified that ESBT's charitable contribution limits are computed on the individual and not the trust rules and limits. That means A, that it's 50% of income, not 100%, but B, I don't need specific provisions in the trust agreement authorizing the charitable contribution to be made. So, it clarifies that we treat this like an individual for charitable contributions, not like a trust. And that one at least should work better, having it treated that way for ESBTs. We come up now on a change not for tax-exempt orgs. A tax-exempt entity must compute unrelated business taxable income separately for each business that they operate. If they have to operate separate trades or businesses, they compute UBTI separately for each one. They then, for the tax they're going to pay this year, add up their UBTI from each of those businesses, except if anyone's below zero, you only pick up zero. Now, that one had a loss. We then carry that loss forward the next year, and we can use that to offset income from that business and only that business next year. So what they're doing here is, let's say, and I'm sure what happened with some number of charities, they had money-making business activities and money-losing activities. They'd net the two. Charities can no longer net the profitable and unprofitable business. Rather, they're going to pay the unrelated business income tax on the profitable business. Okay. There is a special exception, NOLs, that exists before this. You can still use going forward. But obviously, in the future, there won't really be NOLs per se. Those losses will be trapped inside of each business. Well, that's the talk about the businesses. As always, I want to remind you, this is brought to you and solely brought to you. The reason why we can do this is because of the work, what the state society of CPAs do and the fact that we're able to produce programs and work through them. Take a look. Make sure you're supporting your state society. I've mentioned that before. If you're not a member, it's time to join. There's a lot of stuff that happens. A lot of things go on there. Get your time there. Take a look at them for continuing education. As I mentioned, we are going to be working with the state societies, looking to try to develop programs in this area. Obviously, there's probably not going to be a whole lot that we can get done. Certainly, there's not going to be a whole lot we can get done before the end of this year for tax planning. And then you guys are going to be in tax season. But hopefully when we get out of tax season, we can start looking at actually rolling out programs that are going to be talking to you about all the craziness of here. Everything I talked about today, we just touched the surface in those areas. There's a whole bunch of detail to look at there. So, take a look. This is something that'd be really useful to actually take the time to go see somebody live. And I realize that a lot of the work we do these days, a lot of what I do is web-based, but I think this is going to help be in the room, be able to ask questions. As I've noted for Arizona, I'm doing a course in January, January 26th. If that is a Friday, I still forgot to check that. If that's the Friday, in the afternoon, we're going to talk about what we can in 4 hours about this bill. And this bill has a lot in it. So, be sure to support them. Be sure to check our daily updates, because this is now the complete, after part 2, update for December 18th. We're going to put updates, and I got some stuff I want to talk about. By the way, some important stuff, especially for those of you in hurricane areas, that the IRS put out regarding special safe harbor rules for casualty losses. If you've not looked at the website, look there. There are important things there. Or even for those of you not in those areas, those of you in California, there are 2 safe harbors you could use. And those of you not in any disaster area, there's still a safe harbor you could use. Of course, outside disaster areas, it won't work much longer, but hey, you got 1 year to use it. Take a look at those. We also have the mileage limits are up for this year, so you might take a look at those on our website, currentfederaltaxdevelopments.com. If you have any questions about these stuff, send me an email, edzollers@currentfederaltaxdevelopments.com. You can also follow me on Twitter. I'm going to post as things happen. I posted to Twitter a link to this bill and a link to the conference report and to the conference bill. They're combined in one giant PDF. So I'll try to post as things happen. I'll try to post things there. If we get something from the Joint Committee on Taxation that explains this thing, I'll try to post that link if that happens as well. And I'll also try to post at least something to Twitter, presumably once we know the president has signed the bill. So we'll keep an eye on that. We're going to keep an eye on the votes, make sure it gets signed. But looks like we're going to have it. So with that, as I said, I would understand if you're not able to join me next week. I expect I can get something up next week, but I'm not totally promising that'll happen. But even if it does happen, I understand why you might not be listening next week. So if this is the last time you're listening in 2017, have a very enjoyable holiday season. Merry Christmas, or whatever you're celebrating this time of year, and enjoy the entry into 2018. Although for those of us in tax, New Year's Day always is that kind of, happy, and because, hey, I have the day off, I'm eating, watching the games, and also realizing tax season's right behind it. Hey, you can't have everything. But we'll see you back as we enter into 2018, and we'll see you whenever you come back, either next week or in 2018, here with us talking about what's happening in the area of federal taxes.